morning, everyone. Happy New Year. Thanks, Todd, for that overview. Wow, lots going on here. Bringing us up to the future. So great to be here this morning and talk about the apartment sector. Lots happening. What a year, huh? Wow, lots ups and downs in the past year. But what it's showed us is that the multifamily sector has been resilient despite the pandemic, shutdowns, the Delta variant, Omicron, you name it. The multifamily sector really just ended 2021 steaming. It's moving ahead in all fronts. So good place to be. And we're here today to kind of talk about the market fundamentals and talk about what happened in 21 and what's going to happen hopefully in 22 and beyond. So I'll give a little quick brief intros here. My name's Matt Mullins, Maxfield Research, real estate consulting firm. Do market feasibility work, highest and best use, strategic planning for our real estate clients as it relates to development. And I'm here to my left with, I got Brian Anderson at CoStar. Brian's a director of market analytics, where he leads the firm's research and analysts for Minnesota multifamily, office, industrial, and retail. So it looks like pretty much everything, huh? So he's got the whole commercial real estate covered there. He's a Minneapolis native, spent his entire career working the Twin Cities market. Prior with CoStar, he was with KPMG's Economic and Valuation Group. And prior to that, he was with CBRE's Valuation Advisory Group. He earned his CPA from Ernst & Young in the banking and capitals market. So it looks like we have some, our paths crossed there. I also worked for KPMG back in the day in the real estate hospitality and with Clifton Larson Allen. So kind of a similar career path going there. And online, we got Tom. If you ever see Tom, give a wave, Tom. Here's Tom O'Neill. Tom is the Vice President of Market Analytics at Colliers Mortgage, national multifamily lender. Tom deploys market and economic data in strategic ways to support key Colliers mortgage operations. Tom regularly presents research on the Twin Cities market at these events and other real estate events throughout the course of the year. All right, that's a quick overview. We got about 20 minutes today, so we're gonna kind of just dive right into it and just go over the highlights of the market. So I'm gonna kick it off with the deliveries of 21 and what's kind of in the pipeline today. So I'm gonna move over here. Multitask here. See if I can get my screen to work. Okay. My slides are not moving here. Well, we'll add limit. So 21, another gangbuster year in the delivery sector. We had another record year, a fifth year straight now, where we're up 5 years straight and running. On the new construction deliveries, we delivered about 11,200 market units across the market. About 80% were in the market rate sector. About 20% were in the affordable sector. So it's certainly seen some uptick in the affordable housing production. We have to run it? All right. To the rescue there. So you'll see quite the run up we've had over the past 5 years plus in the construction sector. And 2022 is looking pretty hot as well. So right now in the pipeline, we've got almost 11,000 units already slated for 22. So another gangbuster year going forward. And so far 23 is looking pretty quiet at this point, but of course that's going to change as the year progresses. But the big shift we've seen and we've been talking about recently is just been the shift from the suburban mobility popped up there. It's just the suburban shift. So over the past 5 years, we've certainly seen the movement from the core cities, Minneapolis, St. Paul, to the burbs, and that has been something we've been talking about for a while, just due to the fact that the burbs really have no new products. So this past year, 60% of new deals were suburban, and this year, 22, we're looking at nearly 70% is suburban. And again, I'll stress these numbers don't even count the exurbs, so we're not even getting to the right counties. St. Croix, Polk County, Sherburne, and whatnot. So that's a whole nother game right there. There's a lot of activity happening there. So going forward here, actually not moving. Had a couple slides on Todd to the rescue again. All right, give me my wingman here, huh? All right. had a couple slides on just where delivery has occurred over the past, 21 and at 22. Hot markets certainly has been in 21, the Woodbury 94, Lake Elmo markets, a lot happening there. We have some single family built for rent going on. Maple Grove, another hot market, but certainly seeing that the product type move out. And at 22, but certain to see a lot happen in Dakota County. I think the one that hit me was West St. Paul. That West St. Paul submarket down by Maple Grove Heights, and on 3 there, a lot of activity going on. Certainly a lot of activity. Other Dakota County markets starting to see movement on that 494, 62. Richfield's got a lot coming online, a lot in the pipeline. So that's just kind of a real brief overview of where we're at for deliveries. So now we're going to shift gears here and talk about rent growth. That's a hot topic this past year. Ryan, as we look at rent growth and compared across the Twin Cities, it's been fascinating to see what's happened just nationwide this past year. I mean, nationwide, we've had record rent growth, it looks like. We look at double-digit percentages as a country this past year of rent growth, and a lot of that's been driven by the Sun Belt states, Smile states. We're seeing, the Phoenix markets, the Vegas, the Miamis, Tampa, 25-30% rents. But I want to talk about Minneapolis, St. Paul, and Twin Cities in general. Do you want to give us kind of a recap on where we're at today, rent growth as we compare to the rest of the country, and then maybe take it a step further and let's break it down between the urban versus suburban product type, and maybe even some of the Class A versus B and C product type as well.
Yeah, certainly. Yeah, thank you. So to your point, in terms of annual rent growth, we finished 2021 with a 3.6% annual rent growth metro-wide, which was just wait one sec here till we get. Yeah, okay. So 3.6%, that was a new record for the metro. Based on going back to 2001, which is when CoStar began tracking the data. And, that is about 20 basis points higher than the previous annual record reached in 2017. And that's about 120 basis points higher than the 10-year annual average. So there we go. Yep. So here we go. Even though we did see these record levels of rent growth, there are a couple caveats. One is the fact that this is being inflated by, no rent increases at all in 2020. And secondly, when we compare it to the U.S. average, we're seeing the U.S. average north of 11%. So the fact that the Minneapolis metro trails the U.S. average by almost 8% is especially discouraging when, we note that in the 3 years leading up to the pandemic, the Twin Cities metro had an average annual rent growth that was roughly 30 basis points higher on average than the U.S. average. So, the fact that we're seeing this huge discrepancy is somewhat eye-opening. And when we actually compare this, the rent growth in the Twin Cities to rent growth in the 50 other largest metros with at least 75,000 units of inventory, we see that the Twin Cities ranks dead last, and by a substantial margin at that. So we're 130 basis points below the next worst performing market with at least 75,000 units of inventory. And and so again, this is definitely alarming. The Twin Cities has always been, a lower growth, higher yield market, but certainly not to this extent. In the high growth markets we're seeing here, it's kind of underscoring trends we've seen leading up to the pandemic, where the Sun Belt high tech hub markets with a little more affordability, less density, we're seeing an outsized share of that rent growth, capturing a lot of in-migration and wage and job growth. And so astonishingly here, we've seen on the left-hand side, we have 8 markets across the nation with at least 20% annual rent growth, which is, absolutely remarkable. In understanding why, the Twin Cities is underperforming so much relative to the U.S. average, it's important to analyze trends across urban, CBD, and suburban submarkets in the Twin Cities, because we're definitely still seeing a bifurcated and nuanced performance across these areas. So, here we're seeing that, although the CBD apartments captured the most growth in 2021 at 4%, this still wasn't enough to recoup the, historic 6% losses that it witnessed in 2020. And, there's a confluence of factors for that, and very similar factors that we saw, same factors last year, the fact that the shift to remote work, the hybrid work model there, and then you're seeing, also definitely, so kind of similar trends we saw last year are kind of taking form this year as well. So I do want to point out, again, we are still about 2 percentage points below pre-pandemic rent levels in the CBD. And so Minneapolis is actually one of 4 metros across the entire country in which CBD rents are still below pre-pandemic levels. The other 3 are in California, San Francisco, San Jose, and East Bay are the other 3 where CBD rents are still below pre-pandemic levels. And so I do want to point out that, when we look at the CBD, we are taking into consideration apartment properties in downtown Minneapolis, as well as apartment properties in downtown St. Paul, which, as you're all aware, and we'll get into this a little further just, in a couple minutes here, but, as of the rent control ordinance passing on November 11th, the St. Paul CBD rents were actually still below pre-pandemic levels. But, one of the anticipated consequences that may come after the passing of the rent control ordinance, which we've seen take place, is the fact that landlords are responding by increasing rents substantially prior to enactment of the policy in May. And so in the St. Paul CBD, just in the month of November alone after enactment, St. Paul CBD rents rose 2.5% in 1 month, which that actually exceeds, the average annual rent growth that the St. Paul CBD experienced over the last 10 years. And so certainly an unintended consequence where, rents that are below pre-pandemic levels, they're scrambling to, increase them back up to market prior to, the stringent 3% cap, basically year over year. So that was something that was helping actually drive CBD rents at the end of the year, even though we're still below pre-pandemic levels, definitely bolstered by CBD submarket. So when we look at submarket clusters, we see that overall in 2021, downtown St. Paul led the way with 9.5% year-over-year growth. And again, 2.5% of that was captured in just 1 month in November, which is typically a month that you see, demand slow down, rent growth slow down. But other than, that, the 3 other submarket clusters that make up the St. Paul, the city of St. Paul also experienced, in excess of 5% year-over-year growth, which is historic levels, again, just to try and get rents to market prior to enactment of the rent control. And then when we look at, other submarkets that are capturing an outsized share of rent growth, we see really well located suburban submarkets where, renters are realizing that, the Bloomington West, the Eden Prairies, Maple Groves, those are areas that offer a similar live, work, play environment as, downtown, if not better, with larger units and, more safety or perceived safety. So definitely driving suburban rents in well-located areas. And so while, even though Matt touched on record level deliveries, that we've seen in the suburbs, the concessionary environment still, pretty much burned off. It's, around pre-pandemic levels, despite record levels of development, just the testament of the strength of the suburbs and how quickly they're leasing up. You compare that to the CBD, and while concessions are down relative to the peak that we saw, beginning of the year, approximately 50% of the properties that we've surveyed in the CBD are still offering concessions in some form. Those concessions have dwindled. In the beginning of the year, we'd see anywhere from 1 to 3 months, and now we're seeing typically just around a month in the CBD, sometimes 2 months. But so we're seeing dwindling concessions, which is a positive sign. And I did want to point out, though, just to show you kind of the shift in the market here. This is showing the 4 and 5 effective rent for first ring suburbs, the 15 cities that make up the first ring suburbs relative to the CBD. And as you can see here, leading up to the pandemic, there was somewhat of a value proposition for, the first ring suburbs with larger units for, a little less rents than the CBD was offering, but that completely flipped on its head. And as of the end of the year, effective rents for the first ring suburban properties in the 4 and 5 star asset class are about $100 a month higher than CBD. And that's what I got for you in terms of the rent stuff.
So, real quick question. What's the most unique or craziest incentive you've seen in the past year?
I mean, honestly, I can't, just, 3 on a 12-month lease, I guess I've heard, 3 months free rent with full year free parking. I mean, that's pretty, that's, okay. I guess in terms of like, I don't know. What about you?
I ran across one that was a $5,000 Christmas cash. It was in December. It was a senior deal, active adult, affordable deal. 5,000 cash. It's crazy. That's the most I've ever seen. Crazy.
Yeah, that's crazy. All
right. Well, thanks, Brian, for overview. A lot to talk about there. Now we're going to jump over to Tom and talk about just kind of the greater broad housing market and how that's impacting the rental side of things. As you know, the for sale market is red hot as well. It's tapered down a little bit recently, but we're at an all-time high again. Median sales price at 340. Housing prices are up about 12%. Supplies at 1.23 months. So we want a 5 months balanced supply. So we're super undersupplied. Builders have picked up production. However, they can't keep up due to supply chain issues, labor, everything else, and they can't build entry-level houses. So we have a huge supply chain and just supply issue overall on the supply side on that for sale. And just want to talk about how that impacts the rental market as we look at, especially the millennials who maybe get priced on the market, or other folks that just are prolonging the rental boom due to the for sale market. So Tom, do you want to comment on just kind of the overall housing market and what some of the changes you're seeing today for demand and how the for sale market maybe has got lifted up the rental side as well?
Sure. And can everyone hear me well? Matt, am I fine?
Gotcha. Yep, we got you.
Okay, great. Thank you. Yeah, it's nice to be here. I'm sorry I'm not there in person, but it's great to be involved in this annual event. It really is a great kickoff to the year, and I'll hopefully provide a little bit of overview. It was nice to hear from Matt and Brian just about some of the stats. I just wanted to step back and look at kind of the larger housing system a little bit. And there are a lot of points that I just won't have time to get into about what's going on with supply chains and all sorts of other things that I'm sure other panels will discuss. But what I want to talk about, and I think this goes along with an article that I submitted that's in the publication I think that you have there. I haven't seen it yet, but I wrote the article so I know what's in it. But it's kind of important to remember the multifamily is really integral to the entire housing system. So bottlenecks in other parts of the housing system affect multifamily housing and vice versa. Some of the key trends that I wanted to just talk about that I will see is important in the year 2022 is, first of all, the lack of new entry-level priced ownership housing, especially in the closer parts of the metro area. It keeps many millennials in particular in rental housing or in their parents' homes. And it's good for those who own rental buildings, but it creates a tighter market for the renters themselves than otherwise it has to be. Another thing that we're seeing that is going to continue in 2022 that I'm optimistic about or happy about is the expanding base of options for seniors. And this includes 55 plus active lifestyle rental buildings, just market rate geared towards active adults, and 50 and 60% AMI buildings on the affordable side geared for seniors. And then senior cooperatives. And all of these should help free up some single family housing for entry-level buyers and families with children. So that hopefully, if that trend continues, that will help with the kind of the bottleneck in the larger system. There's still pressure on the NOAA supply, the naturally occurring affordable housing, from value-added renovation. Tight market conditions overall in the entire system create financial incentives for NOAA purchases. They fix them up, they raise rents, and it takes them out of the affordable supply. So this puts pressure on households in the middle and lower income categories. And I'd love to see more financing programs specifically targeted at NOAA preservation. Another trend that is going to happen, unfortunately, is there's not enough rental housing priced at the lowest end of the spectrum. The 30% AMI renters, the ones that definitely fall outside the market rate system, but nevertheless are very important to help with housing. It's the very low income and the extremely low income households, and if we don't fund that and work towards that, it exacerbates homelessness. It forces higher mobility for families and creates just instability in schooling, employment, social services. Good news, Ramsey County, among others, I think have stepped up with more money targeted at this 30% AMI category. So hopefully we'll see more production in that end of the system. One thing that I've looked at lately, kind of interesting, we don't talk about it too much, but the need to invest in renovation and just replacement of obsolete stock. Back in 2019, Minnesota Housing Partnership looked at this issue, and 39% of the rental stock across the state was at least 50 years old, built in prior to 1970. And we're only building enough housing across the state to just keep up with household growth, so not for replacement. So housing in Minnesota, greater Minnesota in particular, is in need of a lot of investment to stem obsolescence and disrepair. So in my opinion, kind of any type of housing that we can build is helpful. Any type of housing we can put into the system helps relieve pressure on other parts of the system. And I think it's important to keep in mind. So that's what I wanted to talk about today. And I know we're running out of time, but Matt, you probably want to get into rent control and some other things. So I'll step back.
Thanks, Tom. That's a great segue into rent control, supply. So, as you know, hot topic of the day since last November has been rent control, rent stabilization, ordinances that were passed in both Minneapolis and St. Paul. And there's a lot of unknowns right now. A lot of people have a lot of questions. A lot of projects are being put in the sidelines. Lenders having issues with financing. We go on and on. I mean, big picture, as I kind of dug into this rent control issue, 37 states across the U.S. have simply banned it, right? 37 states. Only 5 states have statewide rent control bans. 180 to 200 cities across the country have rent control. And of those states, it tend to be East, West Coast, high market, high barrier to entry markets. So we're the first Midwest market that has really initiated this rent control measure. So I guess I'll start with most of you, Tom, first. Why don't you provide some of your insight onto what's your feelings now, and what do you foresee as in the short term, before this bad ordinance goes into effect, what are you hearing on the street as far as from developers, investors, and as from the lending perspective, at Colliers, what are you seeing?
Yeah, certainly producers are not happy about rent control measures. I understand the interest from the advocacy side. The affordable housing issue is huge, and I can understand why there would be a political response to this issue with rent control. But in my opinion, it is not the right solution. It's asking the private ownership market to solve a problem that's really it's a public problem. It's a lack of public funding to produce more affordable housing, and so I don't think it's going to be helpful at all. To me, as I indicated just a few minutes ago, it's a supply and demand issue. It kind of gets back to Econ 101. We need more housing supply, and once we have that in a variety of different segments, I think it'll ease pricing pressure and help the affordable housing situation. I would love to see, rather than rent control, I'd love to see regulatory relief from local governments. Everything from park dedication fees on affordable housing, just waiving those, density bonuses, all sorts of things I think local governments can do, and just generally be much more supportive for multifamily housing in general, whether it's market rate or affordable. There's still a lot of NIMBYism and a lot of resistance and bias towards multifamily housing. So I'm not in favor of rent control, and I don't see it as being helpful in the end.
Yeah, thanks, Tom. We could spend probably all morning on this topic. Any last comments you want to make, Brian, about rent control? You did some work in St. Paul.
Definitely, I think, as I mentioned earlier, we're talking about the rents, one of the, quantifiable impacts we're seeing already is the fact that, landlords are aggressively increasing rents at a pace we've never seen. So in November alone, across the city of St. Paul, we saw rents increase 2%, which, that actually is in line with what we'd see, as the average annual amount we increase over the last 10 years. So it's just incredible rent hikes already, which I, project will continue until it takes effect in May. And, I kind of echo the sentiments made, that it doesn't really address the imbalance of supply and demand, which is the driver of rent growth. Especially in St. Paul's policy, where there really isn't another case study. Every other policy considers inflation to some extent, considers new housing to some extent, and vacancy decontrol, new tenant move outs. So it's definitely kind of a lot of question marks and not a lot of answers at this time. But certainly we're seeing investors, lenders already pause development, which was one anticipated potential impact, and also hike rents in the interim as well. So yeah, I think definitely seeing some ramifications right now.
All right, well, great. Again, we could spend all day talking rent control, but unfortunately, we got a lot to tackle today, and we got the broker session next. So thank everyone for hearing us out on the market fundamentals. If you want our slides, just send us an email. We're happy to send them along, and we appreciate the time here today and look forward to enlightening day about the multifamily sector. Thank you.